Imagine waking up to a life where your investments are working hard for you, paving the way to financial freedom. Sounds like a dream come true? Well, in this eye-opening video, we're about to reveal the ultimate key to unlock your investment success. Welcome to Investing Insights, where we unveil the best investment strategy that will take your financial journey to new heights. So what exactly is this winning strategy? How can you turn the stock market into your ally and multiply your wealth? Before we reveal the secrets, let me ask you something. Have you ever wondered why some people seem to struggle financially while others thrive? Well, today we're uncovering the truth behind this common dilemma. Investing is a fundamental activity in the financial world that involves deploying capital with the goal of generating returns over time. Within the realm of investing, there are various strategies that investors employ to achieve their financial objectives. 5 prominent investment strategies are value investing, growth investing, dividend growth investing, and dividend investing. Each of these strategies has its own unique principles, goals, and advantages. Value investing. Value investing is an investment strategy popularized by Benjamin Graham, often referred to as the father of value investing, and further propagated by Warren Buffett. This strategy is grounded in the belief that markets occasionally misprice stocks, leading to opportunities where stocks trade below their intrinsic value. The primary goal of value investing is to identify such undervalued stocks and purchase them at a discount. Value investors typically look for stocks that have a low price-to-earnings (PE) ratio, a low price-to-book (PB) ratio, and other metrics that suggest the stock is trading at a discount relative to its underlying fundamentals. The idea is to buy when the stock is undervalued and hold it until the market corrects its valuation, generating a profit in the process. Growth investing. Growth investing is an investment strategy that focuses on identifying companies with the potential for rapid earnings growth. Unlike value investing, growth investing prioritizes companies that are expected to experience above-average revenue and earnings expansion, often fueled by innovative products, market leadership, or other competitive advantages. Investors employing the growth strategy are willing to pay a premium for stocks that exhibit strong growth potential, even if their current valuation metrics are relatively high. This is because the emphasis is on the future potential for significant returns rather than immediate value. Growth investors often target industries such as technology, where rapid innovation can lead to substantial market share gains and revenue expansion. Dividend growth investing. Dividend growth investing is a strategy that revolves around investing in companies that not only pay dividends but also consistently increase their dividend payments over time. This approach is attractive to investors seeking a combination of income and potential capital appreciation. Companies that engage in dividend growth are often mature and financially stable, allowing them to share their profits with shareholders while maintaining room for future growth and investment. Dividend growth investors prioritize the company's ability to sustain and grow dividend payments over time. This strategy provides a steady stream of income and the potential for the value of the investment to appreciate, driven by both dividend increases and stock price appreciation. Index investing. Index investing is a passive investment strategy that involves buying and holding securities that replicate the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. This approach aims to mirror the returns of the broader market rather than attempting to outperform it. By investing in an index fund or exchange-traded fund, ETF, investors gain exposure to a diversified portfolio of assets, typically with lower fees and minimal trading costs compared to active management. One effective way to enhance the benefits of index investing is by using dollar-cost averaging, DCA. Dollar-cost averaging is a strategy where an investor consistently invests a fixed amount of money at regular intervals, regardless of market conditions. This approach helps mitigate the impact of market volatility by spreading out the purchase of investments over time. When prices are high, your fixed investment buys fewer shares, When prices are low, it buys more shares, ultimately reducing the average cost per share over time. Combining index investing with dollar cost averaging can be particularly powerful. It allows investors to build wealth steadily and avoid the pitfalls of trying to time the market. With lower costs, diversification, and the disciplined approach of DCA, this strategy offers a reliable path to long-term financial growth. Dividend investing. Dividend investing, as opposed to dividend growth investing, emphasizes investing in companies that pay regular dividends, regardless of whether those dividends are increasing consistently. This strategy is favored by investors who prioritize immediate income generation rather than aggressive capital appreciation. Dividend investors seek out stable companies with a history of paying dividends, as these payouts can provide a steady income stream that may be particularly appealing during periods of market volatility. This strategy is often favored by retirees or those seeking passive income from their investments. In conclusion, the investment strategies of value investing, growth investing, dividend growth investing, index investing, and dividend investing represent distinct approaches to deploying capital in the financial markets. Each strategy is driven by different principles and objectives. Value investing seeks to identify undervalued stocks and capitalize on market mispricing, while growth investing aims to capture significant returns from companies with high growth potential. Dividend growth investing focuses on companies that not only pay dividends but also consistently increase them, offering both income and growth potential. Dividend investing prioritizes immediate income through regular dividend payments. Investors often choose a strategy based on their financial goals, risk tolerance, and investment horizon. Diversification across these strategies can also provide a well-rounded portfolio that balances various investment objectives. It's important for investors to thoroughly research and understand each strategy before implementing them in their portfolios, as successful implementation requires a deep understanding of market dynamics, company fundamentals, and economic trends.